Hello and welcome into the KE Report. Corey and Chad here as your host, and we're chatting today with John Rubino, and you can follow John over at his Substack page. We'll put a link to that down below so you can follow along with his work. And John, always great to get you on the show, just to pick your brain on what's going on in the macro sphere, what's going on in some of the geopolitics and how they tie into economics, but also, of course, what's going on in the resource space. And I guess we'd have to lead with gold. Gold has had a great 2024, but it's even off to a bigger start in 2025. We were talking just off mic that the annual average price for gold was in the 2600s last year. Now in 2025, we've seen gold rocket higher up to the 2900s plus, getting close to that $3,000 level, which seemed like a really far away just a couple of years ago, and now it's here. Now, there's a lot of reasons for that, everything from central bank buying to people wanting to get in front of some of the tariff news. There's a little bit of uncertainty as far as the economic future, not just here domestically, but abroad. So what do you make of the ratchet higher in the precious metals?
Hey, Corey. Hey, Chad. Yeah, it's almost like panic buying out there right now. There's an awful lot going on. We don't know the absolute cause of anything that's happening, but definitely Trump's tariffs have played a role out there, because it looks like people are trying to get their gold back home just in case a tariff makes it impossible to get it back home or extremely expensive to get it back home at some point in the future. So you're seeing a lot of action like that, and one of the wild things about huge amounts of gold flowing from London to New York, at least I just read this, if there's an intermediate stop. London and New York use different size bars. So London has to ship gold to Switzerland, where it's melted and recast and then sent to New York. So this is crazy stuff that's happening out there, but long overdue stuff too. I mean, this is what we three have been talking about for years, that should be happening in the gold market eventually, when physical starts dictating price. Another thing that's interesting besides the tariffs is that China is now beginning to let its insurance companies invest in gold. And insurance companies have a ton of money to invest. So we don't know what that is in terms of ounces of gold or yuan or dollars or anything, but it's possible that it's another notable thing in the gold market that actually has a positive impact on the price. So far, so good. It's nice to enter a year that is actually a positive one for precious metals. And here's hoping that it stays on this trend line for a while.
John, it's really crazy when you take a step back and you look at all the things going in favor for gold. There's all the geopolitics of tariffs and trade wars. And then there's also the economic data of inflation being a bit higher than expectations, and also forward expectations for inflation being much higher, again, mostly tied into the tariffs. But the other market side of thing is slowdown in the tech and crypto trade. So all these so-called competitors to the gold trade, right now gold is outperforming. Have you seen an environment like this where it does seem like politically, economically, and even market-wise, everything is lining up for the gold trade?
There have been some really excellent precious metals markets in the past, but this one is at least potentially by far the biggest and wildest of any that have come before, because the numbers are so much bigger now. We got ourselves out of the Great Recession by basically, tripling the amount of debt globally that was out there when we were already wildly over indebted in 2007 before the housing bust and everything. So we've created the conditions that are basically just perfect for precious metals. We have no choice but to try to inflate our way out of all the debt we've taken on. And that's great for gold and potentially great for silver. Inflation is not going away. Normally when the Fed starts easing, that's because the economy is slowing down in a scary way, scary enough to push the central bank to start easing again. And the Fed started easing back in September. But since that time, long-term interest rates have gone up by about 100 basis points in the US. And inflation, by most metrics, has not gone down to the Fed's 2% target rate. It's actually gone up somewhat. So, we're looking at potentially 3 and maybe 4% inflation going forward, which means the Fed is going to have a lot of trouble cutting going forward. And long-term interest rates might go up for here. So, that's a lot of stuff happening that has that creates cross currents for precious metals. So it's possible that there's a big recession and a correction waiting out there for precious metals. But right now, it's a really nice environment. And meanwhile, we can't forget this because it's more important than it has been in the past. But the U.S. president is demanding lower interest rates from the Fed. Trump, being a real estate guy, knows that, cheap money is the lifeblood of the economy. And he's basically out there just saying, the Fed needs to cut interest rates immediately. And then the other central banks of the world need to get on board with this program. And that's new. Normally, obviously, presidents lobby the Fed for easy money pretty regularly, but they don't normally just shout it out in press conferences and stuff like that. So, and Trump has an extraordinary amount of power right now to affect things during his honeymoon. So it's completely possible that Trump is able to hold off on Fed rate increases and maybe force them to cut rates a little bit from here, which, we'd be doing that in the face of the everything bubble. And that's new. That's uncharted territory where you cut interest rates aggressively in the face of a massive financial bubble. That, again, is really good for precious metals is if we actually try to do something like that. So, don't jump into anything with both feet. But the highest quality miners that are making good money right now look like pretty good bets.
Well, John, just one other thought on gold before we jump into those miners, because they're racking up the money right now with these margins. But when you look at gold, the other thing to keep in mind is it's up in every currency. It's not just up in US dollars. It's up in the yuan. It's up in the yen. It's up in the euro. It's up in the Aussie dollar. It's up in the Canadian dollar to record highs, which highlights a point you've made for really decades as the founder of Dollar Collapse, that most of these currencies are what's actually moving in purchasing power. People look at currencies on a chart and currency pairs, and they fail to understand that gold has not changed just a rock. It's still the same rock it was when it was $35 an ounce. Now that it's $2,900 plus an ounce, all that's changed is the amount of dollars it takes to buy it, the amount of loonie it takes to buy it, the amount of yuan it takes to buy it. So maybe as an uncurrency or a currency of last resort, do you think that's also what's attracting the global bid for gold?
Oh, absolutely. The world's big fiat currencies have entered their death spiral in the sense that a lot of them, there's so much debt at the governmental level in those countries that the interest cost on that debt is reaching bankruptcy levels. And, it has to be borrowed each year, which means it's higher in each successive year. And there's no way out of that. So, we've entered that phase. And that could account for a lot of gold buying. And, central banks in general are big buyers of gold now, whereas they were big sellers until, let's say, 12 years ago. And part of that is the whole, fiat currencies are clearly dying thing. And the other part is that a lot of the rest of the world doesn't want to be held hostage by the U.S. using the dollar as a weapon. So they want to replace the dollars in their reserve assets with gold, which is neutral. You're not making a political statement by owning gold, whereas with the dollar, you're making a political statement. You're choosing a side, and you're putting yourself at risk from erratic U.S. governments doing things like tariffs and sanctions and kicking you out of the SWIFT international banking system, things like that. So gold has a lot to recommend it to central bankers, and they've been acting on that premise. They've been buying pretty aggressively. So yeah, there are lots of reasons to be owning gold out there if you're a central bank or if you're an individual. And it's kind of now all coming together where there are lots of people who are, happily buying gold right now, even at today's prices, because they see even more extreme market conditions out there in the future. And again, the currencies are in a death spiral. So there is no end to that process. There might be like recessions on the way down in which inflation drops and maybe we even get a little deflation for a year or two in this process. But the overall trend is definitely to the fiat currency's intrinsic value, which is zero. And to the extent that more and more people recognize that, it makes more and more sense to buy real assets like gold and silver and farmland and uranium and oil, things like that. And we're seeing that shift happen now. There's a capital asset shift moving from financial assets to real assets, and that's only going to accelerate.
Well, there's a clear move into the gold price. A lot of the other commodities have been, in a way, kind of range bound. And we do also need to understand that, look, the U.S. markets haven't fallen out of bed by any sense. They're still very close to all-time highs. So clearly this capital flowing into precious metals, gold especially, and also into the underlying stocks too. You look at GDX. GDX has been up pretty much every week this year. It's up 7 weeks in a row, up 25% from its low just before the turn of the calendar into 2025. Very strong move into the gold miners. John, what are you seeing in terms of gold miners that's, I guess, just further drawing this strength and, quite frankly, having the miners completely outperform the metal?
Well, yeah, if you're a gold miner and your production is stable, but the price of gold goes up, that's good. You generate higher revenue, and if you control your costs, you generate higher profits. But if your production is going up and the price of gold is going up, that's really a double-barreled good thing for you. You know, you make massive increases in revenues, and there's a decent chance that a lot of that filters down to the bottom line and your earnings just explode. And we're kind of starting to see that with the best run miners. You know, the guys who can control their costs are looking at really good comparisons now. And Barrick, who, you know, you can't really call them one of the best run miners or anything, at least in the last couple of years, but they and Royal Gold just reported excellent numbers with nice increases in revenues and then big increases in cash flow. And that's the kind of thing. Oh, and their stocks popped on that news. So that puts them on two different sets of momentum screens. You know, people who are looking at earnings momentum, these stocks show up, and people who are looking at price momentum see these stocks popping up too. So that attracts a lot of generalist money, people who don't necessarily care about mining and don't really understand it, but they do understand a trend line that's sloping up aggressively. So I think that's going to be the thing that really kicks in the not too distant future. If gold stays here, you know, if gold stays at $2,900 an ounce or goes up from here, then the gold miners are going to generate all kinds of momentum related numbers that are attractive to generalist money. And we'll see a really nice run for these guys. It's beginning, like you said, GDX and those kinds of ETFs. That's what people get into when they think, oh, I like gold, but they don't understand anything about necessarily money or gold or mining. They just see it moving and they want to buy some. Well, they buy something like GDX because it's easy to understand. It owns all the big gold miners. So that starts the parade. You know, that goes up first. And then people start looking at individual stocks and individual smaller stocks, and they work their way down to the explorers. And decent chance we're in the the third inning of a 9-inning game as far as that goes, with money moving down the food chain in the mining sector. So I think there's a decent chance that the next couple of years are just really fun for people like us who like the explorers that really haven't done all that much lately. Although, you know, a lot of them are starting to pop now too. So it could be that this is the year that things turn for the exploration sector, and that maybe a lot of these guys see their stock prices go up. They're able to do financing on favorable terms and put that money to work in a market where the gold and silver they're exploring for and finding is getting much more valuable, you know, and you get a nice feedback loop there. So again, no way to know for sure, a lot of cross currents, but there's a decent chance that we're at the beginning of a really fun stretch in precious metals.
Yeah, John, it would be nice to see some of the exploration stocks have some much needed capital flow into their companies so they can start doing more work on the ground and start finding more gold. But there is a whole group in the middle between the producers and explorers that I'd like to ask you about. And it's all the optionality that you would see in development companies that were the hot explorers of the past. They've already done a lot of drilling. They've already defined millions of ounces of gold sometimes, and they're still at really low valuations. And also the higher cost producers. So maybe not the best in class. I don't want to say the worst in class, but just higher cost producers. They're going to see margin expansion on a percentage basis that's a lot higher than even the best run companies if gold stays up at these prices and if silver keeps hanging up there. Do you put any stock in the idea that some of these optionality plays, either the higher cost, smaller to mid-tier producers or the developers that are sitting on a lot of ounces in the ground, still have a catch-up trade in front of them?
Well, for a developer, the closer you get to production, the more interesting you become. And for the explorers and the developers who have already outlined really good properties, really good resources, there's going to be a lot of M&A activity for them because the big guys, they're generally not replacing their resources with their own exploration. So they need, if they want to stay in business, to go out there and find new reserves somewhere. And they've got a ton of money to throw at this now because cash flow is going up dramatically for most of the big players out there. And in the mining industry, there's pretty much what you could call a historical fact, and that is that eventually rising amounts of cash and higher cash flow burn a hole in the pockets of the CEOs of the big companies, right? They're going to go out there and start throwing some of that money around and building empires. And we're kind of at a place where historically this is where it starts to happen. So yeah, if you're a good quality developer or a junior who's just beginning production, then I imagine you'll be getting a lot of phone calls right now. And where those phone calls lead is anybody's guess, but in a lot of cases it'll lead to a takeout at a pretty nice premium, which is for us, for we three, right? That's a mixed blessing, right? Because some of these things we own, we think of as 10 baggers. And if somebody comes in and buys them out for a 50% premium to last week's price, it's a 50% gain, but still, it's in a way, it's a disappointment. So I'm not sure I really, I know exactly what I want to happen, because in some ways, having the M&A mania be 2 years out at crazy high prices would be better than having it start right now. But we don't get to choose, it's going to go how it goes. And I do think that it's highly likely that there's going to be a lot of acquisition activity in this space in the next year or two for sure.
Hey, we've already seen a lot of M&A activity, and now if we can start to get some activity at these higher prices, shareholders should be happy. And quite frankly, I think we should cheer for more M&A so that it does free up capital. John, one other thing I want to ask you about in the trading in something like GDX is that volumes have still remained relatively low. We've had that noted by a couple people on the show. What's your takeaway from seemingly gold and the gold stocks having this momentum, but not seeing the correlated volume on the back end of that?
Well, that means some people are buying, but nobody's selling, right? If you have an increase in low volume. But again, that produces nice percentage gains, which puts funds like GDX on the radar screens of momentum guys. So the volume will come along with even more dramatic price increases if this is a relatively normal cycle. Because we've seen this in living memory. It happened in the 1970s, and then it happened even more dramatically in the 2000s at the end of the Great Recession. And, I don't see any reason to expect that kind of history not to repeat. And if it does repeat, then that means today's low volume will be replaced by extremely high volume with big price increases in the not too distant future.
John, we've talked a lot about gold and the gold stocks, and they are getting the lion's share of the interest from investors. Even anecdotally, just at the conferences we've just attended, we've been at 3 or 4 of them recently, and they're all really corralling people into the gold and gold stocks. What about silver, though? Silver is a precious metal. It's an industrial metal. It's a hybrid. It tends to get pulled along with gold. It is up at higher levels now in the mid 32s, which is a great place if you're a producer of silver. Now, the stocks are really volatile. They're sometimes the most, I think SILJ was the most beat up ETF at the end of last year compared to the other 3. So the junior silver is the most beat up. Are you looking at silver as a way to get a little leverage on even the gold action, or are you avoiding it?
Oh, I have way more silver than a normal person should have as a percentage of overall money. And, speaking of history repeating, what normally happens in a precious metals bull market is that gold goes up first because that's the name everybody knows. And then it gets really expensive relative to silver. And then silver takes off and outperforms gold in percentage terms for a couple of years, with the final year being just straight up. Okay. And no reason to think that won't happen again. And another reason silver is attractive, though, too, is that it's very cheap relative to gold. The gold silver ratio is like 90 right now. And if you go back through precious metals history, you'll see that 90 is usually a really good entry point for silver, because after that, silver tends to outperform gold in percentage terms until you get the parabolic blow off. So there's one spike in the silver gold ratio up to like 120 during the pandemic when everybody was just terrified. But other than that, 90 is a really good entry point. So I would say physical silver or the silver miners are probably going to be among the best investment category stocks of any over the next few years. Again, there's that recession out there that worries me. Silver is an industrial metal, so you could have a kind of a V bottom thing that happens to silver, a flash crash. But over the next few years, I think the 90 gold silver ratio and the fact that silver, even leaving gold out of the equation, it is a really attractive story because of its industrial uses and its monetary uses. I think silver is going to be a really nice thing to own, and it might be one of those things that we look back on as one of our best ideas now. It's among our worst ideas, right, over the last 10 years. But I think we're entering the part of the cycle where it does some spectacular things. And then one of the things that we three will talk about in coming years is where to take profits. That's going to be the thing with silver, because if it goes to 50, do you want to cash out? Or is this a 150 market? And if you sell it at 50 and it goes to 150 and you waited 10 years to get out at 50, that wasn't so good. So it's going to be very stressful to figure out where to raise money out of silver, where to take profits. But that's a good problem to have, right?
That can be a good problem to have, especially when I know so many people have looked at their silver stocks and been kind of disappointed with their performance. There's been a few good stories out there, but quite frankly, you look at a lot of the pure silver miners, they haven't been producing the type of numbers that the gold stocks have been. Now, that is because silver, yes, it isn't breaking out to all-time highs, but historically, this is a very good level for silver. So, John, if you're looking at silver stocks, do you favor the ones that are more gold, silver, a combo of that? Or do you actually like these pure silver miners, even though still they've been disappointing and their numbers still haven't been that great on the earnings front?
Well, those two categories are not mutually exclusive. I think we should own both some primary silver producers. Highest quality, though. In a raging bull market, the crappy names that are way down tend to go way up sometimes. But I just think on principle, you should only own quality. And, there's a handful of them out there. There aren't all that many just great silver mining stocks out there. But the best of the breed, you should own some. And then, having gold and silver together is a really nice profile. A lot of the companies I'm noticing now have copper too. They've been picking up some copper assets in the meantime. And that's a nice profile as well. I think both of the big guys who reported last week, Royal Gold and Barrick, are gold, silver, copper. And, those are all good things to own. They're all real assets that will tend to go up as the currencies of the world collapse. And copper and silver have excellent industrial profiles too. So, I wouldn't buy any category of these things to the exclusion of the others. You should just own really well-run companies. And if the best quality company happens to have some copper along with a lot of silver and gold, that's great. And the quality is the thing, not so much the ratio of metals going forward.
Well, some good thoughts there. I think we'll wrap it up there for today, John. But yeah, nothing wrong with having a little copper in the mix. It's also had a nice bounce recently up into the higher mid fours. So maybe it can push its record from last year up to almost 520. We'll see what happens as 2025 unfolds. Some people still worried about the economic contraction impacting things like silver and copper if we do see a cooling off in the economy. But it looks like the pricing for all these metals has been in an up factor for 2025 thus far. So nothing wrong with having a nice mix in a producing company that can catalyze on those higher prices. John, always great getting you on the show. And if people like getting John's thoughts, definitely check him out over at Substack. He writes about all kinds of things, whether it's the macro side of the markets, geopolitics. He dives into the companies, and he, of course, shares with his subscribers what he's doing in his own portfolio, which is always interesting to read. So, John, great to have you on the show. And as always, looking forward to our next conversation.
Thanks, guys. Talk soon.